The stock market, a realm of dizzying highs and gut-wrenching lows, where fortunes are made and lost in the blink of an eye. We often envision it as a game of winners and losers, a test of wit and strategy. But what if I told you there's a darker side, a hidden cost often overlooked? A world where profits hinge not on growth, but on the misfortune of others. Welcome to the world of short selling. Imagine a vast ocean, its surface teeming with ships, each representing a company. Investors, like seasoned captains, steer their investments, hoping to navigate the turbulent waters of the market and reach the shores of profit. Now, picture a rogue wave, a force that doesn't lift all ships but targets specific vessels, dragging them down to the depths. That's short selling in essence. At its core, the stock market operates on a principle known as the conservation of capital. Money doesn't simply vanish, it changes hands. For every winner, there's a loser. Short selling exploits this delicate balance, turning profit by betting on a company's downfall, often through ruthless tactics that leave a trail of devastation in their wake. This isn't about mere speculation or hedging risks. It's about exploiting vulnerabilities, amplifying negative sentiment, and profiting from the destruction of value. But the true cost, the human cost, often remains hidden, buried beneath layers of financial jargon and complex trading mechanisms. It's time to shed light on these shadows, to understand who really pays the price in this high-stakes game of financial speculation. Short selling at first glance seems counterintuitive. Why would anyone bet against a company, essentially rooting for its failure? The answer, like many things in finance, lies in the pursuit of profit, even if it comes at the expense of others. Here's how it works. Imagine a trader believes a company's stock price is overvalued, poised for a fall. They borrow shares of that company's stock from a broker, promising to return them at a later date. Then, they immediately sell these borrowed shares at the current market price. If their prediction holds true and the stock price drops, they buy back the shares at the lower price, return them to the broker, and pocket the difference as profit. Sounds simple enough, right? But this seemingly straightforward transaction has far-reaching consequences. The problem arises when short sellers, instead of merely riding the wave of market sentiment, actively manipulate the system to their advantage, spreading false rumors, publishing misleading reports, or orchestrating coordinated sell-offs to artificially depress a company's stock price. These tactics, often bordering on market manipulation, can have devastating consequences, not just for the targeted company, but for its employees, investors, and the wider economy. And while regulations exist to curb such predatory practices, the reality is far more complex, leaving unsuspecting individuals vulnerable to the whims of these financial predators. Rajesh Sharma, a hard-working engineer, had poured his life savings into a promising tech startup, hoping to secure his family's future. He believed in the company's vision, its potential to revolutionize renewable energy. Little did he know, his investment, his dreams, were about to become pawns in a high-stakes game orchestrated by ruthless short sellers. News broke of an anonymous report filled with fabricated data and baseless accusations alleging financial impropriety within the company. Panic ensued. Investors, spooked by the rumors, started selling off their shares, sending the stock price into a tailspin. Rajesh watched in horror as his investment, his family's security, evaporated before his eyes. The company, unable to weather the storm of negative publicity and plummeting stock value, was forced to lay off employees, including Rajesh. His dreams of a secure future, of his children attending college, were shattered. What Rajesh and countless others didn't know was that the anonymous report was the handiwork of a group of short sellers who had heavily bet against the company. They had deliberately manufactured this crisis, manipulating the market to profit from the company's downfall. The Sharma family's story is not an isolated incident. It represents the human cost of short selling, the devastating consequences of a system that allows a select few to enrich themselves by exploiting the vulnerabilities of others. Their story underscores the urgent need for reform, for regulations that protect innocent investors and ensure a level playing field in the financial markets. The damage inflicted by predatory short selling extends far beyond individual investors like Rajesh Sharma. It can set off a chain reaction, undermining the stability of entire industries and sending shockwaves through the global economy. Consider the ripple effect of a successful short attack on a major corporation. The company, once a pillar of its industry, now faces a liquidity crisis. Investments dry up, projects stall, and layoffs become inevitable. Suppliers reliant on the company's business suffer collateral damage, their own operations jeopardized. The fear and uncertainty unleashed by such an event can spread like wildfire through the market. Investors, witnessing the downfall of a giant, become wary, hesitant to invest in other companies within the same sector. This loss of confidence can stifle innovation, discourage entrepreneurship, and ultimately hinder economic growth. The very foundation of a healthy market, built on trust and long-term investment, crumbles under the weight of short-term speculation and predatory practices. The interconnected nature of the global economy amplifies these risks. A short squeeze in one market can trigger a domino effect, leading to a cascade of sell-offs across borders, impacting businesses and livelihoods far removed from the initial target. This interconnectedness demands a global response, a coordinated effort to establish safeguards that prevent the exploitation of systemic vulnerabilities and protect the integrity of the financial system as a whole. Ignoring the systemic risks posed by unchecked short selling is akin to playing Russian roulette with the global economy, with potentially catastrophic consequences. Section 5. The ethics of short selling. A necessary evil or market manipulation. The ethics of short selling have long been a subject of intense debate. Proponents argue that it serves as a vital mechanism for market efficiency, identifying and punishing overvalued companies, and keeping exuberance in check. They contend that short sellers act as a necessary counterbalance, preventing asset bubbles from inflating to dangerous levels. In essence, they act as the market's conscience, exposing weaknesses and forcing companies to be more transparent and accountable. However, this argument ignores the dark underbelly of short selling, the manipulation, the misinformation, and the deliberate destruction of value for personal gain. The line between legitimate short selling and outright market manipulation can be blurry, often exploited by unscrupulous actors. The use of rumor-mongering, the dissemination of false information, and the orchestration of coordinated sell-offs to artificially depress a company's stock price are not tools of market efficiency. They are weapons of financial warfare. These tactics undermine the very principles of fair and transparent markets, eroding investor confidence and creating an environment of fear and uncertainty. The potential for abuse is simply too great to ignore, and the consequences of inaction too dire to contemplate. Section 6. The regulatory landscape, existing safeguards and their limitations. Recognizing the potential dangers of unchecked short selling, regulators around the world have implemented various safeguards aimed at curbing market manipulation and protecting investors. These measures often include short-selling bans during periods of extreme market volatility, circuit breakers that halt trading when prices plummet too rapidly, and rules requiring investors to disclose their short positions, promoting transparency. While these regulations provide a degree of protection, they are often reactive, implemented after the damage has already been done. Moreover, the complexity of financial markets, coupled with the speed at which trades occur, makes it challenging for regulators to keep pace with the ever-evolving tactics of unscrupulous short sellers. The global nature of financial markets further complicates matters. Regulatory inconsistencies and loopholes across jurisdictions create opportunities for regulatory arbitrage, allowing short sellers to exploit differences in rules and enforcement mechanisms. Furthermore, the resources available to regulatory bodies are often dwarfed by the vast financial resources at the disposal of hedge funds and institutional investors engaged in short selling. This imbalance of power makes it difficult for regulators to effectively investigate and prosecute wrongdoing, leaving investors vulnerable to exploitation. Section 7. A progressive capital gains tax. Curbing excessive speculation. One potential avenue for reform lies in rethinking the way we tax capital gains. Currently, short-term capital gains, those realized from investments held for less than a year, are often taxed at the same rate as ordinary income. This creates an incentive for short-term speculation, rewarding those who seek to profit from rapid price swings, often at the expense of long-term value creation. Implementing a progressive capital gains tax, where the tax rate increases based on the duration of the investment, could help discourage excessive speculation and promote a more long-term investment horizon. By increasing the tax burden on short-term trades, particularly those involving short selling, we can disincentivize predatory practices and encourage investments that support sustainable economic growth. A progressive capital gains tax would not only curb excessive speculation, but also generate much-needed revenue that could be used to fund programs aimed at protecting investors, strengthening regulatory oversight, and promoting financial literacy. This approach recognizes that a healthy market requires a balance between incentivizing risk-taking and safeguarding against reckless speculation. By aligning tax policies with long-term economic well-being, we can create a more stable and equitable financial system for all. Section 8. Empowering investors' financial literacy as a shield against manipulation. While regulatory reforms are crucial, empowering individual investors with the knowledge and tools to navigate the complexities of the market is equally important. Financial literacy acts as a shield, protecting individuals from falling prey to manipulative tactics and enabling them to make informed investment decisions. Educational initiatives aimed at demystifying financial jargon, explaining investment strategies, and highlighting the risks associated with short selling can empower investors to identify red flags and avoid becoming victims of predatory practices. These initiatives can be integrated into school curricula, offered through community centers, or made accessible online, ensuring that individuals of all ages and backgrounds have the opportunity to enhance their financial knowledge. Moreover, investor protection agencies and financial regulators can play a proactive role in educating the public about the risks of short selling, disseminating information through public awareness campaigns, investor alerts, and online resources. By fostering a culture of financial literacy, we can empower individuals to become more discerning investors, capable of critically evaluating investment opportunities, recognizing potential risks, and making sound financial decisions that align with their long-term goals. Section 9. Towards a more equitable market. Balancing profit with responsibility. The pursuit of profit is undeniably a driving force in the financial markets. However, unchecked greed, fueled by a system that prioritizes short-term gains over long-term value creation, can have devastating consequences. The story of Rajesh Sharma and countless others serves as a stark reminder that behind the cold, hard numbers of the market lie real people, their lives and livelihoods intertwined with the decisions made in the financial arena. Creating a more equitable and just financial system requires a fundamental shift in perspective, a recognition that the pursuit of profit should not come at the expense of ethical conduct, transparency, and a commitment to responsible investing. This involves fostering a culture of accountability, where those who engage in manipulative practices are held responsible for their actions and the harm inflicted on others. It requires strengthening regulatory frameworks, closing loopholes, and providing regulators with the resources they need to effectively police the market. But perhaps most importantly, it demands a collective awakening, a recognition that the financial markets are not a zero-sum game where one person's gain must come at another's loss. By embracing transparency, promoting financial literacy, and aligning incentives with long-term value creation, we can create a financial system that works for everyone, not just a select few. A system that fosters innovation, drives economic growth, and empowers individuals to achieve their financial aspirations without falling victim to the hidden costs of short selling.